Every so often, a company posts a number so big it stops you scrolling. ADNOC Logistics and Services just quadrupled its quarterly profit, up roughly fourfold from a year ago. While revenue more than doubled, and for the third time this year, management raised its full year guidance. But here's the analyst's job today, a number that good demands one question: how much of it is real, repeatable earnings power, and how much is a one-off wave the company happened to catch? Let's separate the two. Officially reported second quarter net profit attributable to shareholders jumped to nearly $917 million from $229 million a year earlier. Revenue surged past $2.5 billion and the company called it a record first half. My read: this is an exceptionally, genuinely strong quarter, driven by a booming shipping market. But the eye-popping growth rate is amplified by weak comparison, and understanding that is the difference between a smart investor and someone chasing a headline. Start with what drove it. Three engines fired at once. First and biggest, the shipping market. Tanker and product carrier day rates were firm, and in a business where costs are largely fixed, high rates flow almost straight to profit. Second, Navig8. The fleet ADNOC LNS acquired is now showing up fully in the numbers, adding scale the year ago quarter didn't have. And third, management moved fast, redeploying vessels to capture volatile rates. Underneath it all is a deliberate strategy, tilting toward high-margin shipping and away from low-margin engineering and construction project work. Now the past mode headline skip. Fact: that fourfold jump is measured against the second quarter of last year, a quarter hit by the onset of the Iran war disruption around the Strait of Hormuz. My interpretation: when your comparison base is depressed, your growth rate looks bigger than the true underlying improvement. The business generally got stronger, but not 300% stronger in normal sense. Read the base before you read the growth. Here's where it gets more convincing though. The company raised guidance for the third time this year, and not by little. Net profit guidance went from mid to high teens growth to the high 60% range. Revenue guidance flipped from an unexpected decline to growth. That's not a quarter fluke talking, that's management signaling the strength is lasting into the full year. And they're backing it with capital. Just days before results, ADNOC LNS ordered 11 new vessels for $1.3 billion on top of a $900 million LNG carrier order in July. My read: this is the genuinely durable part of the story. Shipping rate spikes are cyclical and will fade, but new vessels on long-term contracts lock in revenue for years. Management isn't banking the windfall, it's reinvesting it into contracted recurring income. So is it sustainable? Partly. The cyclic half, spot shipping rates, can reverse. The structural half, a bigger fleet on long-term charters plus the Navig8 scale, is real and lasting. A smart investor separates the wave from the tide. Does management sound confident? Unmistakably. The CEO called it a record first half built on disciplined execution. They declared a dividend and they are spending billions expanding the fleet. This is a team leaning all the way in. My assessment: the long-term story is strengthened, a larger, modernized fleet and a decisive shift to high-margin shipping. But the headline growth rate flatters what's underneath. Before next quarter, watch three things. Shipping day rates, because they are the swing factor and they are cyclical. The base effect, because comparisons get harder as the war hit quarters roll off. And fleet deployment, because new ships entering long-term service are the durable, non-cyclical growth. The blockbuster number is real, just don't analyze it blindly. Profit quadrupled, guidance raised again, and billions going back into the fleet, with one caveat every investor should hold on to. That's ADNOC LNS this quarter.